Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I hope you guys are okay. I hope that you are, still investing. You have not sold everything. I haven't posted anything for the last couple of weeks because been really busy with family and everything else. And about a week ago we went to Qatar, Doha, and it's been absolutely amazing. Just got back last night, and really good holiday, amazing place. It makes the UK look like a third world country when you come back, and but it's been really good, alhamdulillah. I feel energized. I've got a lot more energy now, and inshallah moving forward I will be posting quite regularly. If you haven't heard from me lately, I apologize, because the market has been absolutely brutal. To be honest, for the first time for a very long time, I literally closed the application, basically the trading tool into account, and I have not opened it again. Like, I haven't really been looking at all. I just decided not to look at it simply because of what was happening in the market. There was so much negative basically news around, and I can see it basically was going down, I don't know, 5%, 4% every 3 days, if not even every single day. But yeah, alhamdulillah, I came back. I just, for the last basically 2 days, I've been looking at the portfolio, I've been planning, and I kind of started posting as well on the Patreon account. If you haven't joined us, you can join us there, inshallah. I'm planning to post regularly as much as I can. And of course, I'm going to do what I can. I'm not going to force myself. If I can't do it, I can't do it. If I have got time, inshallah, I will do it for the community. And I genuinely feel like I owe you guys that much to at least post something regularly, okay? And that's inshallah what I'm gonna do. As you can see, the portfolio has come down so much in the basically since that time of, I don't know, I think at one point it was £124,000. It actually went on negative, I think, a couple of weeks ago, because I was looking at I think the day we were traveling, I was just looking at it, and I think it was down about £2,000 or whatever it was. But just the last 24 hours is up about 3,500. So I think that's probably why it's now in the positive. Otherwise, it would have been negative. But it doesn't matter. I still own 26 basically different companies. I will be doing a full portfolio and update, inshallah. I've started adding basically my £250 a week, inshallah. I'm going to talk about the entire portfolio in another video, but I just want to let you know I haven't basically sold much. In fact, yes, I have sold some stuff about 2.5 weeks ago. I can't remember exact date, but I've made some sales, and I used that money to kind of rebalance the portfolio. So I've not sold the companies just for the sake of it. I sold them because for whatever reason at that point, and I'll explain that in another video, inshallah. So yeah, there has been some change in the portfolio, which I will share with you guys. But the moral of this story is, alhamdulillah, I feel I've got a lot more energy. I'll be posting as much as I can in the next few weeks. And what we would like to do today is not just talk about the negatives and every crazy stuff that's happening. You know all of that. You don't need me to repeat. You just go on YouTube and just type stock market crash, and you'll find a million things about it. I'm not going to repeat that. We know the tariff situation is. We are one tweet away from Donald Trump to just say, oh, by the way, all these tariff things, yep, nonsense, we're stopping it. And the market will go back to whatever. The uncertainty will basically stop. But if he doesn't do that, we can also head in the opposite direction, where we might see earnings declining for companies. Why? Because they're no longer making the same sales, or it's costing them more to buy these products from these and other countries or whatever, or sell these products to other countries. So there could be, we might even end up in recession. Let's see what happens. But you know what? I don't really care. Genuinely, I don't really care. The reason I don't really care is because my time horizon for this portfolio and for my investment journey is 10 plus years. And for the next 10 years, Donald Trump will not be a factor in the basic what happens today. Okay, that's probably what's going to happen. So what I'm going to do now is I'm going to share with you guys 10 different companies that are high quality businesses, because a lot of us are, what we're trying to do is buy any shiny new company that comes up or whatever. We're trying to buy all the AI companies. We don't have a diversified portfolio that can weather this type of situations. Do you have energy companies? Do you have material sector? Do you have, the REITs? Do you have technology sector? Do you have the consumer discretionary, consumer staples? All the 11 different sectors of the S&P 500 should be in your portfolio, just to have a wide diversified portfolio. Or go the ETF route. If you're not doing all of these madness about individual stocks, then do the ETFs. So what I'm going to do today, I'm going to share with you 10 high quality businesses, okay, that are, some of them are undervalued right now, some are not. But if we get, opportunity in the next few months, then of course some of these companies will be a great addition to your portfolio. So you just need to look at that. One of the things I want to focus on today is one of the reasons we say in these companies are compounders, or like these companies are high quality businesses, is because return on invested capital. They have a very high return on invested capital. Return on invested capital basically is a calculation used to assess a company's efficiency at allocating the capital under its control. So companies get money from us, they get money from the bank and so on, and what do they do with that money? They reinvest it into the business to generate more profit for us and so on. So some of these companies have a very high return on invested capital, which is really important. It's something that I read the Terry Smith's book a while ago, and one of the things that he always emphasizes is companies that have a high return on invested capital. And that's when I learned from this, and I was like, okay, this is great. So, for companies that have a high return on invested capital are basically very profitable businesses that are run really well and so on. And these 10 companies have that in common in this video. So again, like I said, some of them are undervalued, some of them are not. And as always, what we're looking for is basically the same information, but these two things that I'm looking for today is high return on invested capital and wide moat. The moat protects a business from its competitors. Okay, so this is the castle in the middle, and you've got that basically protection around it that nobody can basically come in there in that business. So there are reasons why these companies have a wide moat. There's different reasons. By the way, I've shared I think all 10 companies, or maybe no, I think 10 plus another 5. I think it was about 15 companies that I've shared on the Patreon account. So if you haven't joined us there, then of course join us there. You can get access to it. I think you have to just be basically part of the community to get it. You don't have to subscribe yet. What I mean is that you don't have to pay, I think, to get access to that. So you can have a look at that, inshallah. So the two main things are the yellow part. I'm not going to read every single information. I'm just going to go over some of these things. And so yeah, let's start with Taiwan Semi. The first one, 678 billion market cap, wide moat. And as you can see here, profit margin, return on equity, and return on invested capital is probably one of the highest in the world. Right, return on invested capital of 21%. That's absolutely amazing. Free cash flow is absolutely brilliant. They're expecting the earnings to grow amazingly next year, but according to Morningstar valuation, basically they expect the price to be $271 per share, which $273 per share, which is about 80% upside from where we are right now. Now I'm going to use software that I have been using lately. It's called Fast Graphs, and this is kind of valuation model that basically uses all types of models to tell us the fair value for stocks and so on. So the first part is the history part of this whole thing. Okay, so the history of this company, as you can see, is for the last 19 years. That's what we're going to look at first. I'm going to give you an overview of quickly how the software works, and then for the rest of the stocks, I will just do it quickly. Okay, so you've got a few things going on here. Let's just remove this. Okay, you've got this orange line here, which is the fair value ratio basically for this company. Okay, then you've got the normal PE ratio, which is basically what the market likes to trade, basically put on this company. So this is where the normal market thinks the company should be trading at, right? The adjusted operating earnings, okay, this part here, the growth rate is 17.5% for this company for the last 19 years. So the orange line is basically what we use to kind of tracks the earnings of this company. So that's the fair value for this company. And we've got that dotted lines. Okay, this the dotted lines here is the expectations moving forward for the next 3 years. So as you can see here, and basically 2025, we're expecting the PE to be about 17, and so on, so on. Then basically we've got another basically for the 2026 and then 2027. So the next 3 years, basically that's the expectation. This line here, this little line there, okay, that used to be the white line, but now is this color, whatever that color is, and that's the dividends. So sometimes this company sometimes increases the dividend, sometimes they don't increase it. They don't really care too much about the dividends, I guess, and they are expecting. So when you hover over, it will tell you the payout ratios and so on. By the way, I have no affiliation with this company, the software side of it. I'm just trying to make it easier for us to understand how it works before we move on. These graded lines here are the recessions and so on. So this is basically 2020 COVID, if you like. And now I'm going to put the price, because this is the important part. So the orange line is the fair value for this company. The price has been going up and down, but earnings normally, the price of a company normally is supposed to be tracking the earnings of a company. However, that does not happen often. So last 10 years, if we look at the adjusted operating basically earnings growth rate is about 19%. The fair value is about 19, and the normal PE for this company has been 23 for the last 10 years. We're using here operating earnings. Okay, now say you bought this stock here right there and sold it today, you would have made total annual rate of return of 44%. Let's call it 45%. So your 10,000 investment, okay, in 2022, not long ago, okay, just for 2022, would have given you right now closer to £25,000. 10,000 investment, okay, at the basically in 2022 right now would have given you, okay, 25,000 basically dollars for this company, which is absolutely ridiculous. When we look at the last 5 years, which is basically what I'm interested in, is where the company has been. Okay, 2025 they're expecting the earnings to grow. This line here, that middle line, is the earnings expectations. So that's 31%. In basically 31% expected to grow the earnings side of things. 2026 they're expecting about 19%, and 2027 they're expecting about 17%. Now if we go to Seeking Alpha, more or less that information is also there. 31%, 15%, about 11%. So more or less they're similar thing. Now we can look at the earnings, how many people are looking at it. If we go to, for example, analyst score, and you can see how many analysts are looking at this company basically for the last whatever years, okay, basically previously. So there are a lot of people who are interested in this company. So if we go back again history, and as you can see here, for the last 5 years the earnings have basically, they grew about, let's call it 14.5%. okay, the blended PE about 20, the earnings yield of almost 5%, and then dividend yield of 1%. Now the normal PE we said it was 20, the fair value is about 15. So if, for example, let's now go to forecast. So this is basically where the company is been really overvalued over the last whatever years. Look at this. If I had bought there and I sold it today right now, I would have lost about 80% of my money. This is why valuation is very important, because if the company was so overvalued and everyone sells their shares right now, you would have lost a lot of money. And this is why I just want the community to understand the importance of buying this company. If you bought it there when it was undervalued, just below this orange line, and you sold it today, you would have made 37% basically a rate of return for every single year for the last whatever years, for the last 3 years or 4 years. So it is important to buy these companies when they are these or below this orange line if you can. Now let's look at the forecast for moving forward for this company. So they're expecting the earnings to grow by the next basically about 19%. Here we go. 21% closer to. The fair value is 20. So if I click this now, you would see we're expecting if things stay the way they are, and these comes through, these basically 20% whatever, we're expecting total annual rate of return of 24%. So your 10,000 investment will become about almost £18,000 in 3 years, to basically December, the 31st of December 2027, which is really good. So right now, if you were to buy this stock right now, okay, and that happens, then we will be making a really good return of basically money for our return. Good rate, basically our rate of return basically for every single year will be about 24%. Now the normal PE, which is what basically the market likes to value this company, is about 25. Say we are basically, the market is right and we get that 25 whatever, we're expecting about 34 basically total return basically for the next 34% for the next per annum every single year for the next 3 years, which is absolutely amazing as well. So same timeline, but this time about more. So either wherever you look at, this company is expected to grow basically better, and I think it is really undervalued, and based on this it seems very much undervalued as well. So from now on, I'm just going to quickly show you the stock. I'm not going to go over every single detail that we just talked about. The next one is Novo. Okay, as you can see here, profit margin, return on equity, return on invested capital is probably the one of the best out there, and it has a wide moat. Now the company, of course, we could talk about the products that they have and all of that stuff. That is for another video. Maybe you can, maybe if you request another video, maybe you just do one single video and where we just talk about this company. But as you can see right now, they're expecting the price to be about $90 per share. That's for almost a 50% basically from where we are now. Okay, so if we go on Novo and just basically see what fast graph shows us. So if you go back to the history and click maximum, for example, okay, what you will see, we have the price. Look at this. The stock was better to, you would have been, it would have been better for you to buy around here and potentially sell it there, because you would have made 24% every single year for your money. So you would have had 10,000 basically. I think that was 2011. If you bought it 2011 and sold it in 2023, okay, you would have, and for just 10,000 investment, you would have made $157,000 including dividends, which is absolutely ridiculous, right? Now this is why it's important. So a lot of people, maybe people have been holding on to this company, some of these hedge funds, where they say, oh, sell it now, whatever, because they bought it when it was really cheap. Some of us are buying it here right there on the top and then selling it right here, and we're losing about 60%. So we let 10,000 investment, it becomes 4,000 investment, which is absolutely ridiculous. So it was so overvalued, and right now we are here. So now we're touching that orange line. The orange line is about 17. The normal P is 24 for this company. The adjusted operating earnings growth rate of 17%, which is absolutely amazing, right? And then when you look at the blended BEO of 17 and the EPS yield of almost a 6%, which is quite good. Okay, right now that orange line, if we buy it right now, this stock, okay, you're making about 16%. Now let's go to the forecast quickly. And from here to the basically the expecting the earnings growth rate of 18%, let's call it about 19%. 18.5 is the fair value. Right now, if you bought this stock right now and this comes through, this becomes reality, in fact, you'll be making 23% per annum. The normal PE we've already seen is about 30 for this company for the last whatever years, and if that happens, that 30, we'll be making about 47%. So wherever you look at, this company also seems undervalued. Right, so the next one, we're going to be slightly faster. So this one, Fasten, is basically one of the companies I own in my portfolio. And as you can see here, they have absolutely amazing total return on invested capital of 23%. And if you bought this stock right now, according to Morningstar, you basically will have about 14% upside from where we are. So $108 per share is where they think the price should be. And according to basically Fast Graph, as you can see here, for the last basically whatever year since 2010, okay, up until now, you can see the stock has been overvalued so much. If we just focus on the last 5 years, we're looking at about 21% when it comes to the earnings growth rate. We're expecting about 21% here. That line is now 21. And when it comes to PE, and the normal PE is about being closer to 40 almost. Okay, and right now it seems overvalued based on this. But let's look at the forecast moving forward. Again, we've got the 15 PE, which is there. So if you bought this stock right now, you would be actually losing about 22%. So you're gonna have to wait for this one to drop massively. Although Morningstar is saying is this, okay, you just want to be cautious because right now it's not that cheap, I promise you. Okay, the next one is also on another one that's very similar. So right now it's a little bit overvalued, so you might want to wait it for a bit longer. So about basically you'll be losing about 5% if you bought it today. That's basically what we're trying to say, downside of 5%. Now if we go to fast track for this company, it's more or less the same as well. If we click history and we click max, for example, as you can see over the whatever, you would have been better buying this stock around here when it was below that orange line. Okay, and also, you know, I think it was the highest it's been, when was this, 2020 February 21st this year. And if you bought it right now, you'd probably be losing a little bit of money. And if we click the forecast, for example, for this company moving forward, as you can see here, the normal PE of 15, you'll be losing about 14% every single year moving forward. But if you look at the normal multiple for this company, which is basically what the Mr. Market likes to trade at, whatever this company, you're making about basically 19%. So again, this is the kind of judgment that you need to make. Okay. Next one is Visa. Whenever we talk about Visa, we always talk about MasterCard because look at this amazing. Okay, 30% when it comes to return on invested capital. Right now, it actually seems a bit expensive. If we go here, also it seems very expensive right now. So as you can see here, if we go to, for example, last 5 years or so, as you can see, it seems very much overvalued. It's not been trading under that basically orange line, or hasn't been. I think last time, let me just go back to Max and see when this company, so around there was the last time this company has been basically under that orange line. And again, some companies might never even go under because of the, you know, they track on that basically the blue line, because any, you know, there's a lot of investors out there that love technology companies that will pay higher multiples because the returns are absolutely amazing. And that's why we have the normal PE for this company and the fair value for the company there. So the fair value, that they might never go under that fair value, and then I don't think I've ever bought this company under that fair value, but I've bought it around basically the normal PE. So if we look at the last 10 years, for example, okay, during even COVID time, it didn't actually cross that line, but it went under the normal. Okay, and if you held it, bought it around that time and held it up until now, you would have made about 17% per annum. So your 10,000 investment would have become 23,000 investment right now. So if we look at the last 5 years, is exactly the same. Now if we look at the earnings expectations moving forward for this company, again for normal basically 15, you'll be losing about 15%. The normal multiple for this company, for 30 whatever it is, you'll be making about 13% per annum moving forward. So again, that's a decision that as an investor that you need to make. The next one is Adobe, right down a lot, 69% upside from where we are. So if we go back here and just very quickly show you, and again, by the way, I'm not reading all of this information. You can pause the video and basically read through some of those information, because I don't want to make the video any longer than it needs to be. So if we click the history of Adobe, for example, click Max, and you will see there's times that this company has been trading under that orange line, and then it's basically Mr. Market likes to value this crazy. Look at that valuation. If you bought it around there, okay, not there, if you bought it around there on the top and sold it here, you would have lost about 63%. Okay, but if you bought it around here, okay, like when it was undervalued and held it up until there and maybe sold it, remember a lot of people say, what, buy low and sell high, you would have made about almost 285,000 US dollars, okay, since basically 2011 up until now for this company. And this is why it's important to hold the stocks for a very, very long time. Now if we look at the last 10 years, okay, you can see it's about 19 adjusted operating earnings growth rate, for example. And as you can see here, it's actually, you're making about 14%. If that's the case, if that happens again. But if we say, now let's just focus on the last 5 years, and we buy this stock right here and sell it in about 3 years down the line, we'll be making about 3%. Now for moving forward, Okay, as you can see that we're using the expectations, which is about 15 PE there. You're making about 3%, which is what we've seen. Earnings expectation about 11%. But if we use normal PE for this company, which is about 38, you'll be making 47%. Again, another judgment that you need to make, but according to Morningstar, it is undervalued right now. Next one is ASML. I don't want to make the video any longer than it needs to be, but I need to make sure I go through this quickly. So I'm gonna quickly show you ASML, just shorten it to next 5 years, basically last 5 years. And as you can see here, the earnings expectation is about 19%, and as you can see, we'll be making about 5% if that was the case. Forecasting, for example, moving forward, we've got about 10%. So if you bought it today and held it, and that normal PE, it's basically whatever the fair value is about 21%, we'll be making about 10% every single quarter, every single year. And moving forward, when it comes to normal multiples for this company, which was about 40, which is too expensive in my opinion. 38 is basic, 36% is basically where they think it should be. 38% is basically where they basically the upside according to Morningstar as well. I really like FICO. FICO is probably one of the companies that is on my short list for a very, very long time. Look at this. Basically return on invested capital of 46%. Now 1,500 is where they think the price should be. Right now it's $1,872 per share. It's still overvalued. If you look at the last basically since 2005 or whatever it is, okay, you can see it's been flat all these years, and all of a sudden, boom, by the time we get to 2024, the stock is basically gone up so much, ridiculously crazy. It's expected about 27 PE, but look at the line, the difference between the two. So it's gone up so much. But if we look at shorten that for the last, by the way, the growth during that time has been about 16%. So really not a lot, but it's decent enough. But the last 10 years, about 28%. So that's probably why it's gone up so much over the last 10 years. Okay. And when we shorten that and look at the last 5 years, we're looking at about 22%. So 22% growth. And because of that, a lot of investors are betting on this company because they know the growth rate is absolutely amazing. 22 is the normal PE, which is this line here, orange line. And the blue line is basically that almost a 50. Now, if we look at the forecast moving forward for this company, okay, you will notice like that 26, okay, you would be losing about 15%. So it seems very expensive right now. When we use the normal PE, which is basically what Mr. Market likes to trade this company, and look at the earnings expectations of 21%, 25%, and 29% moving forward, which is decent, right? So if we use that line there, okay, we still basically flat for the next whatever years. So we need the company to come down maybe another 10, 15, 20% or more for us to even look at this company. The next one is the one I own in my portfolio is MSCI. This is got the basically return on invested capital of 32%. Right now it's flat. If you like this, basically according to Morningstar. Again, another company that's been similar to FICO, for example, over the years has been okay. It's been basically around the orange line and then between the orange and the blue line. And all of a sudden we got to 2018 and the stocks basically kept going up. COVID is actually dropped back. Even then it wasn't cheap enough. It kept going up and up and up. Right now, look at where we are. We're there. So if we look at the basically that time has been growth has been about 15%. For the last 10 years, growth has been about 18%, and the last 5 years, growth has been about 13%. Okay, and as you can see here, it still seems basically it's between those two lines, but it still seems overvalued. So if I was to buy today and the next 3 years, and that we get that forward PE of whatever 15, what we're expecting is about losing about 15% of our money, which is not great, right? And if we look at the operating, if we look at the forecast, for example, for this company, 15 is again is the same thing. We're losing about 15%. But if we look at the normal PE for the company, okay, which is about 44, whatever it is, you expect it to make about 25% per annum for the moving forward for the next 3 years, which is good, but again, in my opinion, it is expensive. The next one is ADP, automatic data processing, one I have on my portfolio as well. Very high the return on invested capital, 44%, which is absolutely amazing. It seems flat right now. If we go back here, type ADP quickly, this one history, and if we click max, for example, as you can see, if we max it, it doesn't even work. what you will notice is basically about 10% return earnings growth for the last, basically for that period of time. 15 PE, the not fair valued basically was about 15, the normal PE is about 25. Is double A minus rated company, 119 billion market cap, really great company. And the earnings, basically EPS yield of about 3%, which is not great. Basically normally we're looking at about 6, 7, 8% or and above that. Now if we just shorten that time just for the last 10 years, as you can see, the stock's been, during COVID time was probably the best time to buy, and then the best time to sell, it was probably about a year ago. You would have made, basically your 10,000 would have been 30,000 right now. And when we look at, for example, where we are in the last 5 years, about 11% growth when it comes to the earnings growth side of things. Fair value P about 15, normal P is about 27. And right now, if you bought this stock moving forward, so let's see the forecast for this company. That's about the forward PE, the normal PE for this company 15. You'll be losing about 17%, which is absolutely ridiculous. Normal PE for the company, you'll be making about 8% moving forward. So another one that's overvalued as well right now. So all of these companies, basically using this type of software, for example fast graph as well as Morningstar, will give us an idea of whether these companies are overvalued, undervalued. But the most important thing for me genuinely, as moving forward, is that you're buying a high quality business that has a wide moat. They have a return on invested capital that's absolutely amazing. They've got absolutely amazing profit margins. They've got excellent free cash flow. They're expected to grow their earnings moving forward. Okay, and some of them have been paying dividends that have been growing over the whatever God knows how many years. So buying this type of companies, I can sleep well at night and not worry about any of these, basically any of them. And the reason is because I know they're high quality businesses. They're not going to run out business for the next whatever years. And guess what? I do own quite a lot of these companies. I own these 3, 4, 5, 6, 7, 8, 9. The FICO is the only one that I actually don't own. And genuinely, I did not plan it that way. Wallahi al-Azim, I just basically did the research. Basically try to find the companies that have a high return on invested capital, but FICO is the only one that I don't own. And inshallah one day I will own this company. I really like the company, and if it comes down maybe 20-30% in the next few months, earnings are not great or something happens, then I will definitely be buying more of this company. I'm going to do a lot more videos inshallah in the next couple of days. If you are still here, tell me what companies that you own that you believe are basically quality businesses that we should all be researching about. So what companies do you own, or do you think we should be researching more of, that are high quality businesses that are Sharia compliant? Okay, that's what I would like you us to do inshallah. I will be doing more videos inshallah in the next couple of days. Stay tuned for that. Have a wonderful day. Assalamu Alaikum.